This is practice question 2 under financial assets, debt, instrument. And in this tutorial, we are going to continue with the practice questions we started earlier. In the previous video, we explained how Acca Limited reported or presented the above problem in its books. So we are going to look at how Acca Limited is also going to account for this in its book. So let's read the question. So we are going to explain what this problem is all about and how we are going to report it in the books of account. So Acca Limited company invest in 5 million in 10% loan notes. The loan notes are repayable at a premium of 337,440 after 3 years. The effective interest rate or the effective rate of interest is 12%. The company intends to collect the contractual cash flow, which consists of solely of repayment of interest and capital, and have therefore chosen to record the financial asset at amortized cost. Required: explain how the above transaction should be accounted for in the books of Acca Limited for the 3 years. So let's identify the most important aspects of this question. So let's first note that there isn't any transaction cost stated in this question. Another thing that we can notify here is that there is a premium. So let's start accordingly. So Acca Limited invests in 5 million in 10% loan note. So the 5 million loan note is the face value of the financial asset, because we've already been told that it is a financial asset. So the 5 million is the face value of the loan note, and the 10% becomes the coupon rate or the fixed amount to be paid or the annuity payment. Alright, and this 10% is always charged on the face value. That is 10% of 5 million, which becomes 500,000, which means every year Acca Limited is going to be paid 500,000 for 3 years, because Acca Limited is the one who has bought a financial asset, so he is the one who is going to be entitled to that payment. The loan notes are repayable at a premium of 337,440 after 3 years. That's 337,440 after 3 years, which means that the loan note will be redeemed at 337,440 more than the face value. So instead of it being redeemed at the face value, it's going to redeem this more than the face value, which means that in the last year or in the year of redemption, it is going to be the face value plus the premium plus the coupon. In the previous video, it was only the coupon plus the face value, but here you are saying that it's going to be redeemed at a premium, a value more than the face value. So that is what's going to happen. Now let's proceed. The effective interest rate or the effective rate of interest is 12%, and we've already explained effective interest rate, and it is the rate that shows how the financial asset or financial liability will mature over the period. So as we already know, 1 cedi today is not the same as 1 cedi tomorrow or 5 years time. So the effective interest rate is what ensures that your 1 cedi today will have a value which will still be equal to the 1 cedi tomorrow. So the effective interest rate is what makes the value of the financial asset to grow over the period of time. The company intends to collect contractual cash flow, which consists solely of repayment of interest and capital, and has therefore chosen to record the financial asset at amortized cost. So which means that in this question there is one of the conditions for you to amortize. Exactly. And this is the cash flow characteristics test. So we didn't see the business model test, but since they have already told us to amortize, or it's held at amortized cost, we go by what they say. Is that okay? So if the business model test was to be available, we would have checked whether it is to maturity or it is for sale or to be held for trading. Then we will know whether we are going to fair value through other comprehensive income or we amortize. So this question seems so straightforward. Exactly. So the first thing is that there is no transaction cost. So at inception, the face value of the financial asset is what we are going to recognize. Alright. Let me know your feedback on the explanations to this problem. Let me know your comment. So comment down below what you think about it. We are going to the worksheet as we solve the problem. So as I said earlier, at inception we are going to recognize the asset. We are going to recognize the asset. So we are going to debit financial assets and credit either cash or bank. Alright, so we are assuming they paid by cash or by bank. So 5 million, and then we credit cash or bank also 5 million. Only 5 million. So we don't know whether it was paid by cash or bank. So yes, yeah. So being financial asset purchase, right? Alright, so that's 5 million. So as I said earlier, here there's no transaction cost. So we are not going to add anything or less anything. Is that okay? Alright. So the next thing we are going to do is to, as I did in a previous video, we can also make a T account of it. Let's see how it will be in our books. So we debit the financial asset with the value of the financial asset. That's the face value. That's 5 million. That's 5 million. And then we balance it. Alright. So we balance it also 5 million. We balance it also 5 million. So this is the T account. So currently this is what we have in our books as at the beginning of the first year. Alright. As at the beginning of the first year. So as at the beginning of the first year, we have 5 million in our books as the value of the financial asset loan note. Alright. So that's what we are going to record in the amortization schedule. Right. So 5 million. And always when the question is silent, let's know that the financial assets will mature before payment will be made. So we are assuming that payment is in arrears. Alright. So we are going to charge the effective interest rate on the face value, right, or on the value at the beginning of the year. But since in this question the opening value is the same as the face value, that's why I'm saying on the face value, right? So it's the same thing. So we are going to charge the effective interest rate, which is 12%. Is that okay? So let's always take note. Effective interest rate is 12%. Right. So 12%. So 12%. 12% of 5 million is going to give us 600,000. So 600,000 is going to give us 600,000. Alright, so we have that already. And our coupon is 10% on the face value, which is also 500,000. And then we have our closing balance. So our payment has to be in brackets, which we didn't do. So let's do it now. So our payment has to be in brackets, or it has to be negated. Alright. So minus 500,000. Alright. So at the end of the first year, we'll be having 5,100,000 as the balance, the closing balance. So the closing balance will now become the opening balance in year 2. So 5,100,000. 100,000 will be the opening balance for year 2. And also we charge interest on that 5,100,000. That is 12%, which is going to be 612,000. And we will also make a coupon payment of 500,000. Coupon payment of 500,000. So at the end of year 2, we are going to have 5,012,000 as our closing balance, and that will also become our opening balance in year 3. So we'll have 5,212,000. 5,212,000 as our opening balance in year 3. So we were told that our financial asset will be redeemed at a premium. So let's go back to our question. So we were told that the loan notes are repayable at a premium of 337,440 after 3 years. So at the end of the 3rd year, we add the premium to the face value and also add the coupon to it to form our last year payment. So that will be our last year payment, right? So adding these 3, so that's the 5 million, the 337,440 plus the coupon, the last year coupon, 500,000. So we have to charge interest on this, on the opening balance. Alright, we have to charge the effective interest rate of 12%. So when you charge the effective interest rate of 12% on 5,202,000, we are going to get 625,440. That's 625,440. Alright, then we are going to have 0. We are having nothing as our closing balance. Alright. So in this question, we didn't treat the last year as we did the previous one because they gave us a premium, and when the premium is added to the face value, so let's try and do something here. Face value, and here is something like premium, and here is coupon. coupon or payment, right? Coupon or payment. So when we added all these, we had the sum of what? 5,837,440. Okay, and it is equal to the sum of the effective interest rate and the opening balance. That is why we didn't do it like the previous question, how we did it, right? So we are having a closing balance of 0 in the third year. And in the third year, that's the reasonable thing to have, or reasonable answer to have, because in the last year, we are redeeming our, the entity is redeeming itself. So we don't need to have any balance of financial assets in the third year. By then, all payments should have been made to us. So we don't need anything. Okay. So the finance income. So now let's go. Let's see how it will reflect in the statement of profit or loss and statement of financial position. So all these that we've done are working. So let's go. So finance income. So since it's a financial asset, any interest that is paid will be termed as what? As finance income or income on investment. So the first year's own is 600,000. 600,000. Second year is 612,000. 612,000. And the last year's interest is 625,440. That's 625,440. 625,440. So in this question, it doesn't go beyond 2 years, so we ignore anything that's there. And the closing balances. So for the statement of financial position, we are going to report these closing balances. This closing balance, all right. So the first year's own is 5,100,000 to 5,100,000. 5,100,000 as a closing balance, and the second year's own is going to be 5,212,000. 212,000. And the last year, we are not going to have anything there because in the last year, the financial asset has been redeemed, so nothing is going to be presented there. Thank you very much for watching this video. Bye.